Hey there, great. How are you?
Yeah, not too bad. Can't complain. It's actually, well, as you know, quite a sunny day today. A little bit cold still, but yeah, can't complain.
Sunny and cool. Yeah, Steve and for anybody who doesn't know, Steve and I, but by coincidence, live not 10 minutes from each other, so we share the same weather, as well as many other things indeed. But good to have you back. Happy New Year to you. I know we've heard from you before, round the clock, obviously.
Hmm.
A great valued contributor. And interesting to hear what you've got to say today. We're on the eve of a new president in America tomorrow, of course, which
Absolutely.
interesting to
What
see
could
what's
possibly
happening.
go wrong, though?
What can possibly go wrong? And I see there's been some action on the forex markets with your friend Mario making some comments. So let's hand over to you. Let's have a look at your screens, and then we can get started.
Absolutely. Okay, you should be able to see my 8 screens as normal.
I can see that. Wonderful.
Okay.
Okay. Right. Well, Steve Ruffley from steveruffley.com, which I know is your new website that you've recently launched. I'll hand over to you and we can take questions just as we go. Thank you.
Yes, no problem, Simon. Thank you. Okay, good afternoon, guys. Yep, Steve Ruffley. My latest thing, well, it's not really latest. SteveRuffley.com is just, my name and a website. I have so many kind of websites, and I've done so many things over the many years. I thought I'd just kind of consolidate things into one now. So if you want to get hold of me, just type my name into Google. I'm not a difficult man to find. So yes, what is happening in the world? Well, it's all happening, isn't it? Tomorrow, as Simon said, we've got Donald J. Trump, as the most powerful man on the planet. Interesting stuff. Just after that, we've got the UK's decision on Brexit going through the courts. We've got things coming up like Brexit, our actual kind of timetable to leave, and then we've got Le Pen. We've got the Netherlands, putting their two penneth into the EU, no mix. So basically, between now and summer, there's going to be, some major moves in the markets. Now, I was doing a presentation over the ECB, and just taking into account what Mario Draghi said, and it's nothing really that's a kind of major shock. Obviously, it sent the euro down slightly, but we're already, kind of recovering. And again, I'm going to talk mainly, I guess, about Fibonacci today. I think that was what was advertised. But the kind of idea is what we're trying to figure out right now is trading's about being right at the right time, not being right in your opinion. A phrase that I've said a million times now. And the world's getting quite complicated, and the markets are trading very politically. So I've always spoke about my 80-20 rule about understanding that markets move 80% of the time due to technicals, 20% of the time due to fundamentals. Now, the markets are obviously speeding up this interaction with the technicals due to this news. Now, Donald Trump's a prime example of this. He tweets and markets move. It's quite interesting, I guess, that how the modern world is working, and how somebody who has 20 million followers, which actually when you break it down is only 3 million US active followers, how we can actually, hit the markets. And a lot of this is down to algorithmic trading. A lot of these bots just pick up on what Trump is saying, pick out the stock, and trade automatically. So it is interesting the way the trading world is moving. But what I've kind of found is, I just go back to basics. And if you look at my 8 screens here, they might look overly complicated, but they're far from it. The green and red lines are essentially Fibonacci's. And when I see strong Fibonacci's, that I see are forming in the markets, put them onto the chart. So like for instance, I was saying about the euro dollar. I mean, where do you think it's going to go to from that retracement? We've got a hard high and a hard low, so it's going to get back to 50%. 80% of the time it'll do that. So it has. So what does it do from this point? Well, it either rejects the 50% and carries on the recent downtrend, and then breaks through and makes a new low. Then we have other Fibonacci lines down here it can get to, or it finds support on the 50%, and it takes away all Mario Draghi's comments, as being not what they seem to be, and then take on the longer trend, which is actually up. So that's your two options, and all it is basically finding an absolute low and absolute high, drawing your Fibonacci on, and then taking an overall picture of what you think the market's going to do from this point. Now, we don't know what's going to happen in the future, but I mean, when we look through the time scales, the 4 hours, you could argue, well, don't have to argue, that is a bullish trend daily. Okay, lots of rejections to the bottom, a bullish trend. Weekly, not so bullish. Yeah, quite a sell-off, a messy chart, but it gives you the information you want. The market is still on the back of a very strong down move. And monthly, well, no one can argue that we haven't got anywhere near to retracing back to the 50% of the overall down move. So your fibs are just, really kind of compounding what you think, long term, shorter term, shorter term, intraday, that the market still wants to sell off. So happy days, the market's got back to the 50% of Draghi's comments, but really the long-term view technically says to me that the market should still move down. So you can move down to your 15-minute charts. Again, gives you the same kind of view. And what we're really looking for is maybe a push up through the 61.8, a rejection, the market finding resistance back on that 50%, and then moving back down. So that's what you do have in your control. You might not understand the comments that are being said. You might not understand what's going to happen in the world. I mean, not many people do. The so-called experts out there have got everything wrong. Brexit wrong, Trump wrong. Experts are not really having a good time, of their kind of credibility right now. And as an economist, trader, mentor, whatever I'm meant to be, I just make money. I'm not really interested, as I've said, about being right. I'm interested in making money. So when I don't understand necessarily what the markets are trying to achieve, and if you look at any product, it's really trying to understand, where your edge is, and this can be really kind of small. We're not looking for 100, 500 point, 1,000 point moves. As intraday traders, we're looking for an edge. We're looking to try to get into the markets where we're going to take the less amount of pain and can get onside the quickest and bank our profit. Now, realistically for me, I'm looking for anywhere between 50 to 30 ticks, 50 pips if we're lucky, and that can be achieved in these markets in a couple of 15-minute candles. And if you're trading size appropriate, 10, 15, 20, 50, 100 pounds a point, you're going to make good money. And I know it sounds a lot, but it really isn't. Now, I'm going to have to break this to you. A lot of people aren't really understanding the way that the markets have changed recently. I mean, all you have to do is look at the IG share price. I mean, all you have to do, quite simple. I don't think I have it up, but if you go to IG share price, and you look at this. Now, there's a reason why IG has done that. Okay, it's just completely dropped off a cliff, gone from the highs here at 957 to the lows at 457. That's because the FCA has basically come out in their infinite wisdom and says that retail traders, small account traders, like many people out there, can't trade on leverage anymore. So you used to have 200 to 1 leverage. In 6 months, you'd be lucky if you can get 50 to 1 leverage. You're probably going to get 25 to 1. Right? So that is what's going to change. They don't want people with small accounts trading high amounts of leverage because you can't be trusted. A little bit hypocritical from the FCA, which basically, had to rebrand after a near financial collapse with all the banks doing whatever they wanted. But that's the future. So the reality is that if you have smaller amounts and you use smaller leverage, you have to be right at the right time and you have very little margin of error, or you have to trade with a bigger account. And these are the kind of things that I'm bringing through to the market now. That people are going to be surprised by. IG's price, the share price, isn't going to bounce back because it makes its money in 2 ways. First of all, lots of customers, churn and burn, doesn't matter. Yeah, big customers making them money. They have a B book, so they trade against their own customers. Yeah, less customers, less ability to make money. That's why I'm the chief market strategist for Intertrader. We're a market neutral broker. We don't trade against you. That's just one thing that I like. I'm ethically kind of all right with that. They're not trading against and profiting from our own traders losing. So these are things that I'm kind of enlightening people to, and people are just starting to realise. And again, when it comes back to the markets and looking at them, it's just trying to figure out where they're going to be and who's going to be strong. Stock markets, yeah, absolutely. They are record highs, and no matter what market you look at on the higher time frame, every time we reject a sell-off, yeah, the markets have moved higher. Why? There's nowhere else better to put your money. Simple as that. The 1%ers, they're only the 1%ers can afford to buy stock markets. Yeah, and the very, very rich people out here at these high prices. But the market continues to march up because there's nowhere else to get a return. So what do? You scale through the smaller time frames to look for your opportunities. Yeah, and when you see an opportunity when it's low, well, how about this level here? Yeah, this lower 423 spot 6 retracement point, 2264 spot 3. Buy it, make money. Buy it, make money. Buy it, make money. Buy it. Ooh, what are you going to do? Make money. History has a habit of repeating itself. So, I mean, this is just a perfect example of the fibs I run. My fibs will change automatically with market conditions, but we've really reached a peak, yeah? These high, this 50% fib, the one that I always talk about, a 227 spot 3. And where does it find support resistance? 100%, yeah? 161, 261, 423. All you have to do is be looking at, and you can sell. I don't mind. It doesn't matter what your opinion of the market is. It's not about being right at the right time. So if you're selling it here, happy days. If you're buying it here, happy days. You're selling it here, happy days. It doesn't really matter. Again, what the outcome is, as long as you make money. So the fibs are absolutely perfect. And as I've said for literally a million webinars, I've done close to 1,500 webinars now. And it's all about, again, what you're comfortable with. I've been burnt many times, as many people have, selling the stock markets at the highs. They continue to push high if you hold them. But on the short term, if you look on the hourly or even the 15-minute charts, yeah, every time you see these spike down lower, you grab it at a good level and it gives you an opportunity to get out for profit. You don't have to hold it to the high. Yeah, you don't have to hold it for the maximum, but you can very, very quickly take a trade on side by picking it at the extremes. And as I say, if you're trying to buy it when it's red. If you're trying to sell it when it's green. A lot of people forget this. A lot of people are looking for too much confirmation. If you're a short-term trader, you want to be in, you want to be out. And 15 minutes can more than yield your profit in these kind of markets, in these kind of, points. But it's looking for the right moment. I mean, look at this. 2 candles selling back down outside the Bollinger Bands. Sure. Okay, there is no levels here to buy at. There's nothing to give you that support apart from its low. But once we see green, yeah, we see the market with indecision. What's the indecision going to mean? Well, historically, any indecision leads to a market going up. So you hold it for green candles. As soon as it turns red, you get out. I know it's easy to say these things in hindsight, but unfortunately, there's only so many lessons you can be taught in trading before it becomes glaringly obvious. If you can't break trading down to these basic principles, then you probably shouldn't be trading. It's as simple as that. The market's going to give you a few opportunities a day to make your 15, 20, 30 ticks, and they're there every day. Most traders fail for, I'm sure there's been lots of people before me telling you about risk strategies and automated systems and blah, 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 blah. Things are going to change your life. There's nothing that's going to change your life in trading. Nothing. Apart from you. Okay, so that's why I stick to the mentoring. I can pick up very quickly what is wrong with your trading psyche, system, whatever it is, because I've done it for so long. I've met every kind of trader. There's nothing you can ask me that I haven't been told or asked before. It's as simple as that. I just have been in the industry longer. So there's no magic formula. There's no magic system. Automation. Okay, programming is there to make your life easier, like my system here. It doesn't tell me when to buy or sell necessarily, but it puts out the lines that I want on all the products I want. So I can bring up any kind of basic chart, and all of a sudden I want to see what it's doing. So I'll just close these down. I'll go through some fibs again, just to show you guys what it's all about. Let's take something I never trade, just so we can kind of work it out. Swiss versus Japanese yen. Never traded this, but maybe I want to. Maybe I've heard something that comes out. So there we go. Bang. Straight away, I have an hourly chart that tells me, we've bounced off the lower fib. We've now found support on the 50%, so the market's going to make a new high. Where's the next point of support resistance? 116.992. So if I want to get long, then I get long at the 50%, look for a breakup and get out. Simple as that. So you start with your monthlies. Again, if you just do it as a blank chart, you're trying to build stuff up. Simple. Start with the highest time frame. The buying starts here. It runs out here. So you've got an overall target of the 50% acting as an attraction point. What goes up will come down. 80% of the time, a strong directional move will retrace to 50%. That's a strong directional move. No new low, no new high, 50%. There it goes. It comes back. So what happens after this is interesting, that we don't make a full low and new low. We actually bounce perfectly off the 61.8, find some sort of support resistance on the 50%. So you've got your targets here, here, new high, because the overall trend is actually up. So weekly, in that downtrend, you might want to do a mini fib. Okay, so same kind of principle. Buying starts here, stops here. So again, we wait for the market to get back to the 50%, depending on our strategy, but more kind of longer term, wait for it to get down to the 50 here. Yeah, maybe average down to that overall monthly 50%, and then expect the bounce. But now, the more we reject on this short weekly term, the more we reject and move down to the 38.2 and 50, the more likely this is to go on to make a new high. Yeah, carry on with the monthly trend that we saw, and fill these gaps here. And then dailies, again, you could draw some the fibs here are probably the same, as the weekly. But if you want to see where the kind of more emphasis has come back in, maybe you take it from again the 50% here to the highs here, and then you've got another point of potential entry, 50% here. So all of a sudden, you're just building a picture out of movement of fibs. I mean, it looks a little bit messy, but then if you start to just kind of basically take your points of interest where you think the market might get to, based upon your fibs and your expansions. And you just get rid of these Fibonaccis. What you've actually then done is giving yourself some framework to work on. So essentially, this product you'd never traded before, just by doing 3 fibs on the monthly, weekly, and daily, you go to your hourly chart, and it becomes a little clearer. Okay, so if the market does break up, and you're a fairly short-term trader, you're going to get out or try to get as close to 115,955, so probably 1,600, a nice round number as you can. Or if the market fails to get to that point, you get down to 112,986, and then you can start to build anything you want. I mean, you can put any kind of indicators that you want. What have we got? Let's put some Bollinger Bands on, two standard deviations, 20 periods. Well, there we go. Yeah. Every time we've got below the moving average, the market's found support, another indication the market could be going higher. So the moving average is acting as support. So if the upper Bollinger Bands break, you'd be expecting a break. It's unlikely that it's going to break up in one candle, 180 ticks to the upper point. But you've got an idea that the majority of buyers in the market from these points here are still long. So your trade is either get out for your long if you've got involved, a good value in the moving average, or if it spikes up, knowing that it's probably not going to be energy to get here, but if you do see one big spike, try and find some support points on the smaller time frames and then sell for a little dip. So it's all how you make it work for you. This is the whole point about going back to basics. And what we're looking at right now is the relationship really between the pound and the US, the euro and the pound. Well, let's put the euro pound, let's put the euro dollar in as well. Where's the euro dollar? There it is. So what we've got really is 3 kind of markets that we know are really kind of affected by the political situation right now. We've got Brexit, and the UK and the pound has obviously been affected by Brexit. We've heard Theresa May come out and say that we're not going to take any old Brexit deal from the European Union. If it's not good enough, we're going to walk away. So that really means that there's a bit of a power vacuum. The US is off doing its own thing. As of tomorrow, we're going to see Donald Trump as president. He's already said that he thinks that the strong dollar is bad for the US. So how much influence he's going to have over the Fed has remained to be seen. We've heard that Janet Yellen's going to put 3 rate hikes up in 2017 in the US, but then we were told it's going to be 4 last year and we got 1. So the dollar has naturally rallied. So that has led to our pound weakness and euro weakness against the dollar. But the situation's slightly more difficult now because we've now got this battle of when the UK triggers Article 50. It's this whole point of what's going to be stronger in the short, medium, long term. It's going to be the pound or the euro. So the euro's got the problem of it's going to want to make an example of the UK so it doesn't get contagion, and other countries, don't want to, see if they can get a better deal. But the euro is under increasing pressure in many ways. Again, Mario Draghi is really floundering and really stuck in this quantitative easing. Will fix everything. It isn't. Production out of Germany. The figures are getting good. So he's under increasing pressure to put rates to a normalized level. But when that's going to come, it just really is difficult to say. So what's going to happen if the EU does lose some credibility and the UK go out, make all these trade deals, and then sideline the EU, and then there is that risk of contagion? What happens then? Well, I mean, many analysts have said that the euro dollar is heading, to parity. Now, I can't really argue against people like Deutsche Bank. They just have more money than me. It's as simple as that. So if they think that the euro dollar is going to get to parity, then it probably is. Now, we haven't seen anything like this in many products for ever, really. There's 9 months of unparalleled selling, and all you can see is wicks on the high side. So who is anybody to argue that the euro isn't going to actually come out of this Brexit thing worse off? Okay, it's going to lose our money, it's going to lose our support, it's going to lose lots of just general credibility. The bureaucrats are going to, make these things a lot harder than they are, and the EU will expose itself for what it is, a self-serving, kind of red tape entity, that was a failed experiment. So the idea is, what's it going to go, where's it going to go based upon principles we know? I mean, it's basically, we can see the market really has decided and made its mind up here. Okay, it really doesn't want to get back. It's the big selling point. It's oscillated, it's moved, made some lower highs, higher lows, but it hasn't really made any inroads back to upper levels. It's not got any kind of intent to get above 120. So that's, if it got above 120 and closed, then you could say, and you can argue that technically it looks, like people are going to come in and buy the euro a little bit longer term. But that hasn't happened. So negatively, if it's going down and you're looking on the smaller time frames, well, it kind of writes its own picture. If you do the Fibonacci, you can see the 50% rejection, and it mirrors, where it rejected before. So there's lots more red than green, and it just looks like it's really running out of momentum. And your next point is lower high after the 61.8, indecision here on this daily. So if we start to creep down closer on the moving average, then you've got all these lows to take out, which are tantalizingly close, and it isn't under any stretch of anyone's imagination to see this parity level hit. And to be honest, that can be done in a matter of days. If the markets want to, it can smash these levels here, get back, hover around 103,360, and then bang, and then lo and behold, when you do a Fibonacci of that recent down movement, you've got your 161.8 expansion point. And that's down, at 97,466. So it's absolutely conceivable that where we're trading now, after 300 pips, we could be in no man's land. 600 and, whatever, 6,000, what kind of. Well, these are your smaller pips, but it's under no kind of realms of the impossible that we start to have these kind of big daily movements like we've seen before, and we break down in a couple, literally in 2, 3, 4 days, weeks of trading. If the market does get on this selling inertia again, then you could easily see these bottoms taken out. And again, your fibs go all the way down here. So it's just saying on this movement, there's been quite a long period of movement now. If the fundamentals support it, and the bigger picture in the world says that actually we have more faith in the UK going out doing some quick trade deals with, the likes of India, Australia, China, and then when the EU catches up, it's going to be in a much worse place. So we're getting out of our euros, and sticking it in pounds. So that's the euros against the dollar, obviously. So that's the Trump inclination. Okay, and Trump's already come out about NATO and that kind of stuff. I mean, the whole point is about these trade deals. You think about Australia. Australia did 18 trade deals in 18 months. So they can be done quickly. It's only the European Union that's trying to hold it up. So this against the dollar is basically Draghi versus Trump. If then we look at the euro versus pound, now you see the longer term picture. The markets really were quite buoyant after the kind of Brexit announcement for the euro, because the euro, second biggest economy in the world, UK is a small country, we're going to steamroll them, we're going to make them pay. Okay, right, well that's absolutely fine, but unfortunately the arguments are a little bit more complex than, basically, is pound better than euro? So what we've seen is the euro make massive gains against the pound. Now again, if we want to try and find some value, we can, really look, we did it on a blank chart again, where the kind of value has been. You can't really go too far back in the charts, because this is a different, back in 2007, this is a different world. It's Brexit was never even on the cards. Trump was never even on the cards. But, we've seen this gap up. So we can really say the markets have taken this gap, okay, they've closed it back down, but really the rejection in the euro losing, kind of ground has gone from here to here. So yet again, we've got a solid low and a solid high from the markets can get to. So essentially, we're looking back for the decision point of the euro. It'll be, first of all, when it hits and breaks and closes below 38.2 at 84.17, and then 81354 would be the 50% pivot point. Now, we're on the monthly chart here, so, I mean, it's difficult to argue this is a particularly bullish or kind of, bearish long short-term trend. it's up and down. So essentially, you know, we've closed this gap now and the market's recovered up. So short term, medium term, it's bullish. But then you have to kind of put these political arguments and these overall Brexit versus EU arguments into one picture. And who do we think is going to win? Now, this is where it's difficult because you're trading technically, but then you're also trading on the back of fundamentals, which nobody, hand on heart, can really say what's going to happen. But in my kind of gut, which has served me well over the years, is that the EU's backing itself into a corner. If it wants a fight, then, you know, it's going to get a fight from the UK. And we're not going to take it lying down. That's what Theresa May actually said. We'll walk away from a bad deal. Now, nobody's saying we're not going to do a trade deal with the EU. We have to. We're practically neighbours. We have, you know, security concerns. You know, we have border issues. You know, we have a lot of things. But at the end of the day, we're the fastest growing economy in the Western world. So the EU doesn't really have the luxury of sidelining us too much. You know, they've got too much to lose. You know, as have we. But, you know, trying to look at this through, you know, objective eyes. When we look at the weeklies, again, I mean, where would you really, you know, you could start drilling down on these mini fibs and saying, okay, yeah, although we had a bit of a rejection there, the market's still looking pretty buoyant. So again, that 50% of that smaller weekly move has come into play. So what you're getting now is these areas of interest that I call them. You don't have to call them support, you don't have to call them resistance, you call them areas of interest. So as the market now is rejecting, you know, the euro is rejecting strength against the pound and it's coming down, you now have these mini fibs that come into play, 23.6, 38.2. So we close below that, then this is a double fib point now, a double point of interest. Then if we start to break and close below that, I would say there are much more chance of hitting the overall 50% and making a new low short term and medium term from this. So I would expect, if my kind of political, which is not my strong point, but my political then economic head kind of breaks into what I think is going to happen in the medium short term, I'm expecting the euro to lose credibility and to lose general traction against the pound. And I expect this to be a major decision point here. And then below that, the 50%, then going on to make new lows all through the range. And I would expect, if the euro continues to slide against the dollar, there will be that correlation with the euro sliding against the pound. And I think easily we could get down to 65 in the euro versus the pound. Okay, you know, again, it's just building up pictures, you know, it's building things up, you know, in a way we can all understand. Then we've got the pound against the dollar. The pound against the dollar is a difficult one because obviously we've got the euro in the mix in its own mind, but then we've got the pound versus the dollar. We were going to be best trade buddies under Trump. You know, we're going to all be good friends. So again, you look at the dailies, we've seen, you know, obviously after this monthly sell-off, you know, that's continued from the Brexit and the fear, you know, the weeklies have continued. Is there much room for the pound to go down? There is, and we could get down to 115, possibly 110. I cannot see it getting to parity or getting any lower. There just isn't the lack of credibility in the UK to push it down. I think a lot of the pushing down has been done. And I think as we set our stall out and, you know, we see our relationship with America be more parallel, be it via Piers Morgan or Nigel Farage, I don't care how we do it. I mean, it's a dog-eat-dog world out there. No matter what gets us through the door, let's just get it sorted. And then I think the pound has a natural progression to strengthen against the dollar. And it's not at the expense of the dollar. I think it's the expense of other currencies. And I'll go through some more exotic pairs against the pound in a minute. But I think that realistically, if you come through to the days, we can start to see that, you know, the 50% is really starting, you know, from them higher time frames to act as a trigger point. You know, we've closed this you know, this gap. We've rejected, you know, a break below 120, which would be pretty frightening for, you know, a lot of you know, traders. You know, it would have held and started to find resistance on these points, and we can see that there's definite solid points that the pound can cling to. And if we do start to outstrip the EU with negotiation prowess or trade deals or whatever it is, as soon as we get above 128, I can see, and I've always said this, that the pound's going to be back to 164. Yeah, that's where I see it in the next 6, 12, 18 months. I just think that somebody who used to rule 2/3 of the planet has a better shot than a lot of bureaucrats in Europe. And I know it's, you know, you start to get a bit patriotic and you start to, you know, get your judgment clouded, but you put us in a corner, we'll fight back. And, you know, I think the Euro have had it their own way for a long time. And, you know, you've got I'll just list off the top of my head, okay? Germany, migrant problem, VW, Deutsche Bank. Okay, Trump doesn't like NATO. Trump doesn't like Merkel. Then we've got in France, Le Pen. We've got the Netherlands talking about their own referendum. Yep. We've got Greece, banks failing, credit failing, always going to fail. Italian banks, credit failing, always going to fail. Spanish unemployment, youth unemployment, terrible. Portugal's unemployment, youth unemployment, terrible. Right? That's just a couple of things listed off the top of my head. And that's the fundamental side. But the technicals seem to be showing that the euro is in no way fixed. There's no real confidence in Draghi or his measures. And that's why I'm selling the euro and looking to other things like the pound. So for me, from a technical perspective, I'm buying dips in the pound against the dollar and the euro, selling highs in the euro against the pound, and selling euro against the dollar to the highs. Now, if I stick to basic, Fibonacci principles, which I've put on the charts, yeah, entry point, exit point, entry points, exit points. Doesn't matter how you do it, what time frame you build it up upon, but as long as you have an idea of a strong directional move, a trend, an amount of movement that makes sense in your head and ties up with your fundamentals or your view of the world, you've got the confidence to get in the trades and stay in the trades. Now, these things are gold dust. If you read the Rough Guide to Trading, there's a whole part on Fibonacci. Sometimes I'll trade with nothing but Fibonacci. Again, I've shown you if you strengthen it with Bollinger Bands, maybe RSI, indicators. When you look at my main screens, this is what I look at day in, day out. I just put my screens on. What's the world doing? Yeah, S&P up and down. What do? You buy lows, because you always buy lows in the stocks. There's no bad news for the stocks yet, until maybe Trump gets in. Gold, happy to sell it high, because I think gold's going to hit $1,000. What did I say about the stocks? Buy low dips. Well, there we go. I mean, you don't have to be a genius to know that this previous low could have been a cheeky buy. 10, 15, 20, 30 pips. That's all you need. Yeah? Euro. Getting to a high point. It's a 15-minute chart. Flick back to your hourlies. Yeah? So about start selling back on that 50% maybe to get down. Yeah? Maybe the dollar will help us. Maybe it won't. But again, these correlations that you see, that dollar strength equals euro weakness, pound weakness, is not necessarily the coefficients and correlations working in the way they used to because of this Brexit, this European, mix, and then the Trump mix. Everything's kind of moving slightly off kilter. So you can't really take, massive dollar strength to mean necessarily euro and pound weakness. And again, can't necessarily say if the pound drops off that the euro is going to drop off. So that's why, again, you have to look for the markets in a slightly different way and have that fundamental undertone. Everyone's battling for their own particular will and their own particular way. And there's nothing to say that, obviously, if you look at the dollar yen, we've all kind of predicted this strength coming in with the Janet Yellen interest rate hikes. But once he gets in, Trump, he's not friends with Yellen. So maybe she goes, and maybe his policy monkeys change, and maybe it starts to come down to these levels because Trump said he wants to be a massive exporter again. Make America great. Well, that doesn't help with a strong dollar, does it? So maybe he comes out and says no until my way, with production is where I want it to be. No more rate hikes, and then bang, the dollar gets hammered. So maybe that's another indication of why the pound and euro could strengthen again at different rates because it's not necessarily a direct battle. So, I mean, it's one of these things. I think the whole point about trading is it is very difficult to tie up short, medium, long-term expectations fundamentally because everyone has got everything wrong, to be honest. And then the technical side doesn't really go away. So what I'm saying is don't go too far back in the charts when you're trying to figure out what the market is doing right now because it's not factoring in all the ever-changing fundamentals, what politicians don't get and what a lot of people in the world don't get, and they can't really help it because they weren't brought up this way, is with the advent of technology, the internet, information, and the more people there are in the world, things speed up. So everything has sped up, but, governments haven't kept up with that pace of change. Look at the NHS, they haven't kept up. Schools, they haven't kept up. Railways, they haven't kept up. Nothing infrastructure-wise that takes a long time and forefront and planning hasn't been kept up with. So how can we expect them to keep up with the markets? Yeah, they can't possibly. They can't keep up with automatic trading. The flash crash. Somebody had an argument with me about a year ago saying there could never be another flash crash because the control's in place. I basically called him an idiot because he's an idiot. And what happened? We had a flash crash because, you can't stop the markets behaving irrationally. That's what they do. But if you put the framework of Fibonacci on, You understand the political side and how much that political emphasis is affecting the markets. And in a different way, it's not just about fear. If it's about fear, then we see gold back at 1,500, won't we? But gold isn't getting back to 1,500. Gold is just trading in these small kind of triangle trends. And when it got back to good levels like 220, it started to pull back. And your fibs, I mean, it looks a bit messy here, but as you start to kind of wind down through it, you know, what do you look for? Your 50%, your 1200 key level. Here's a 61.8. Then we get back down to here, back to the trend, and we're going to get to $1,000, which is a 161 fib retracement of the last decent up move that I can see in gold. So what goes up will come down. Not going to say it's going to happen tomorrow. Not going to say it's going to happen, you know, in the next 6 months. But I have a view, technically, I have a view fundamentally, and I'm putting them together, and I'm using that to trade. And when I see levels like this, my 50%, that's automatically generated by iView charts, I sell with a 50%, take a bit of profit. And I sold here, the absolute high, and took took most of the profit here. Again, used the fibs, came back down, and completed the Fibonacci 100%. So, you know, do you not want 177 pips in gold? You know, we trade 100, 200 pound a point. Yeah, you do. That's good money. But even if you only get 20 pips, these little kind of, you know, smaller inner movements, you're still making money. I mean, at the end of the day, I can't say this enough. It's not about being right. It's about being right at the right time, having a view, putting your money where your mouth is, and then getting out. So I've always been short gold. And you can listen to any of my recorded webinars. You can listen to anything I've said. I was quoted in the FT a couple of years back saying gold will never get back to even 1,500. Not enough fear and greed. It's always going to get to 1,000. So essentially, what I'm saying is, you know, look to the past to predict the future, as always, but use fibs on strong directional moves or extended moves to try and give yourself a balance of what the market's going to try to achieve in the short term. If you don't understand the political side of trading, don't worry. You know, listen to something like Mario Draghi's speech, listen out for the non-farm payrolls, and just see what it does to the markets. The markets will move irrationally around them kind of the information, you know, explosions, but then it will trade technically. There's only two ways you can consistently, you know, look at the markets with Fibonacci, and that's strong directional move, yeah, or the you know, the extended candle. And that is the two ways you can identify very easily on any chart. And it's generally on the smaller time frames for extended candle, so a 15-minute or an hour. And then your strong directional move is anywhere from a day, well, an hour I would say, to a day. Don't try and take in too much. Yeah, for your weeklies and monthlies, you can get for the overall picture trend. But for your day trading, your intraday trading, kind of stick to your dailies and your, you know, maybe at a push, you know, recent weekly moves to get the overall boundaries, and that'll give you your 50% and your key 38 and 61.8 pivots. And is there anything anyone wants to kind of go through? I mean, I could do this in real time in front of you. Is anybody got any products they trade? Anybody got any ideas about, you know, or lack of ideas of what they want to achieve from trading? And they want some kind of insights. I mean, you know, that's what we're here for, guys. You know, me just cycling through.
Yeah, there's a few questions sitting here, just waiting for the right time. George wants to know about counter trending. Do you counter trend trading? Do you trade counter trend on the euro dollar?
Do I counter trend on the euro dollar? I mean, yeah, as I've said, I mean, I'm looking to sell the euro dollar high, and that's mainly because of the overall technical picture, but also for my deep dislike of everything European. No, I mean, yeah, I mean, it's counter. What is counter trend? I mean, the trend is still down. If you look at the monthly, you know, the weekly, you know, it is still down. So the counter kind of trend doesn't really come into it as such. What I'm trying to do is not be market neutral, but be a step ahead of that. If I hear something and Draghi says, yeah, you know, we're done with quantitative easing, you know, it's the right time to stop, we're going to put interest rates up, of course I'll buy the euro. You'd be stupid not to. But in the kind of in the interim, in the lack of any kind of sensible things coming out of the EU, I just find high points and I just sell them. So I don't care if the market bounces from here and I know it's going to get back to here. I don't want to buy it into something that I don't really have the confidence in. So if it just shot up to this point here, I'd expect something's going on. So I'd let it break and I'd sell here and here. And I maybe only sell for a 15, 20 tick pullback. But I have more confidence selling after a rally than I would have buying into any rally. So if that's what you mean by kind of counter trend, I guess so. But essentially, what I'm trying to do is when I look at all these products, I know what I want to do. This is high, I want to sell it. This is low, I want to buy it. This is low, I want to buy it. And it's not that I can't do the opposite. You know, you can do anything you want in trading. You can buy or sell. But I have more confidence when I have my overall view and it ties in with my technical fundamental thinking. Yeah? And that's what it's all about. You know, gold, if it spikes up, you know, if there's no news out and there's nothing supporting that, I will sell much more size into that because my view is that gold is overpriced. Yeah, if you see the euro spike up for no reason and the rest of the currencies don't follow, I'll pile in because I want to sell it high. Again, as I say, you have to be a little bit instinctive right now, and that's why your technical levels are so important, because they hit prices and they go, and the markets can be spooked by anything, thin volume, algos, bits of news, rumors. Yeah, so you can't necessarily, you know, stick to the old ways of trading. You have to adapt with the current markets, and they'll move on anything. They'll move on a tweet. That's how, you know, volatile the markets are.
So, what's better, Tina's asking you, to be a day trader or a longer term swing trader?
Well, I mean, it entirely depends down to what you're trying to achieve. If you want to have single trades with bigger pip wins, then it's obvious you have to be a swing trader because there's only so much a market can move in an hour and can move in a day. But I mean, there's $4 trillion trading FX markets every day, so there's enough money to be made. I mean, there's not. I don't know. What is it for me to say what's better for you? I mean, no point in doing these presentations if I give you an idea of what can be achieved and the tools you can use, and then you have to go off and figure out what's going to work for you. At the end of the day, you know, if you can't sit in front of the screen 24/7, then you have to be a swing position trader, momentum trader. And that's as simple as that. It's, the equation with trading is dead easy. It's what you want to achieve divided by the number of hours and time you can invest in it. Yeah, that's it. I mean, it's time. Time gives you the ability to trade 10, 15, 100 times a day if you can afford the time to do that and you have the capital. If you don't, then you have to follow the longer term trend, and because you don't have as much chart time, as much screen time. So that's it. It's just down to time and money, as everything in life is.
What indicators, Giuseppe, what indicators would you use for trading stocks? And how much fundamental analysis would you do?
Okay, well, again, I've explained it's 80-20. So the fundamental is a 20%. You know, that's all the things to do with Brexit, Trump, you know, any kind of economic data that's coming out. All you have to do is, you know, stick the FX Street calendar on high volatility, click, you know, UK, Eurozone, US, and China, and then you get all the economic data. That's all you have to do, and watch out for the times. The rest of it is made up of this, going to a monthly, working down to your weekly, daily, hourly, yeah, and then figuring out where value is currently in trading. I mean, individual stocks, if you're talking about individual stocks, I don't touch them. I have no interest in them. I just deal with the indices and the you know, and the commodities and FX. So individual stocks, I don't know. I mean, you have to look for earnings and that kind of stuff. You know, for the indices, you just look for the general news. I mean, you know, the economic calendar. You know, that's where it comes from. I mean, it's here. I mean, it's as easy as this. You know, that this is what's important. You know, it's what's important tomorrow. You know, China. Yeah, anything red. You know, just put the filters on and you can find it. That's all the news we have. Yeah, and if it's not on here, then it's surprise news. So you'll get that from a Squawk or maybe some Twitter feed. The rest of it is just technicals, your charts. What's low? What's high? As I say, buy the stocks low. There we go, green. There we go. There we go, green in the FTSE. Yeah, sell gold high. Sell the euro high, 50%, as I said. You know, that's how you make it up. You know, that's how you make up your interaction by having, you know, the right kind of time scales, you know, at your disposal, and then trading on the back of an opinion.
Harvinda is saying, yeah, if your overall fundamental views are not matched by the current price action, presumably you cannot trade.
Well, I mean, I'm not trying to say that I'm right all the time, and I'm not trying to say that my fundamental view is, you know, it's what's currently happening. I'm just saying I've got an overall view. I mean, nobody's ever right all the time, but I have something in my mind that's ticking along and like a running commentary of what I think's going to happen between the euro and UK and eurozone, what's going to happen between America and the eurozone, what's going to happen in the world. I mean, I can't teach you what I think. It's my brain, it's my head. It's 15, 20 years of being involved in the markets. It's impossible, isn't it? We all have our own views, no matter how much we try to suppress them when trading and be neutral. We all have our tipping points, our balances, haven't we? That's just human beings. That's human being nature. What I'm trying to say is, like most traders or mentors will teach you, is try and take as much motion out as you can. So I do. I don't take any motion when I'm selling it, but then I don't buy it because I don't believe in the euro against the dollar. So that's how I get over it. Whatever you get over it, it's down to you. And again, these are things I can help you with.
What about the 50 Fibonacci level, asks Richard, as an attraction level price we'll get to either to enter a trade with your conviction or with trend, or to take profits? Okay.
80% of the time, a strong directional move, yeah, or an extended candle will retrace to 50%. Now, I've said this, again, about a million times. So you have to identify what a strong directional move is. This is a strong directional move, yeah? 4 red candles. So if I want to know what's going to happen after this, I don't know any of this, after these 4 candles, right? If we don't make a new low, as soon as this candle opens, I know that's a specific high and low. So I know that 80% of the time, a strong directional move will get back to 50%. What has that done? 1, 2, 3, 4. No new low. 1, 2, 3. 50%. 50% again, just in case you missed it, and then goes down, makes a new low. Yeah. So this is Fibonacci in action. When you find something that hasn't made a significant, but has made a low to a high point, and then after that hasn't broke them parameters, 80% of the time it gets back to 50%. So do whatever you want. Buy it to the 50%. Sell the 50%. Whatever you want to do to make money. Yeah. It's entirely up to you. But you can't. I can't. That was just by looking at it by plain sight. I can't make these things any more transparent. You have to go through the charts and see if it works or not. If it doesn't work, then it's not going to benefit from the self-fulfilling nature. Okay, so it's just trading. Go out with your Fibonacci tool, go and get yourself an MT4, click that Fibonacci button, and go hunting, go exploring, see how it works for you. I mean, it's not difficult.
I can't help but think of Morecambe and Wise when you talk about 4 candles. We're not talking about the farming accessories here, of course. What about your template? James is asking, do you have your own template? Is this where iView charts comes in?
This is iView charts. This is iView charts, as it says in the bottom corner here. This is my charts. So again, I've got this whole brochure that I've spent a small fortune on doing. So if you want to figure out what it's all about, look at that good-looking guy. You want to figure out what this is all about, just go to steveruffley.com or contact Simon, and then you can get involved in the charts, my mentoring. Again, I'm just it's the same thing, just packaged together as it's always been. If you're interested in trading and you got some money, I'll give you some of my time. If you don't got any money, I'm not interested in helping you. I can't help you. Yeah, you need a minimum of 5 grand, ideally 10 to 25. If you've got above 25 grand, then you can be making, 5, 10, 15, 20,000 pounds a month, as my other clients do. Yeah, as I do. It's entirely up to you. And I'm not here to sell you any dreams. I'm very blunt, as you know. I don't need the money. Okay, so if you do want to get involved with me and make more better decisions and that kind of stuff, then I'm telling you, you have to have some money behind you. And come 6 months, if you don't have at least 5 grand in your account, you won't be able to trade full stop. So, I'm just being honest. Just go and Google the FCA spread betting report, and it'll tell you. It's about 25 pages long. Read it, and it says in black and white that when they put these rules into force, 75% of leverage will be taken away from customers who aren't professional. A professional trader is somebody that has £500,000 of liquid assets. That's what they, allow professional traders to do. So if you ain't got £500,000 in the bank, you ain't going to trade. But what do I know? As always, I'm just trying to give you the best advice that I can.
You're right. Well, I'll put that link in to londoninvestment.com.
I'll give you the FCA one as well. I don't know. Have you got that? I think I did send it you at some point.
Oh, sorry, what was that, Steve?
The FCA publication on spread betting.
We've actually talked about that already a couple of times today as well. Yeah, it's reared its head a couple of times. So
what was the consensus from other presenters? What did they have to say about it?
Well, I think they're echoing yourself. everybody feels that it's it's generally a good thing. We can see why it's a good thing, but I just hope that we don't start to find that there's too much over-regulation going on. But we can see why you do it, and the tenets of all it does is reinforce this idea of easier to make money off smaller moves with a bigger starting capital.
Yes.
That's what we're sort of arriving at this truth with or without regulatory barriers. It was always thus that those that can afford to start with the bigger account don't have to have such huge growth in order to make it's just arithmetic, really, isn't it, that we're talking about? So it was just reinforcing that point. Okay, so going back to the questions. Yes, it was the two Ronnies, of course, Paul, not Morecambe and Wise. Richard asks, you use the DeMark indicator as a faster trigger with momentum. Where can I get a DeMark indicator widget for MT4?
Yeah, the demark indicator is on MT4. I think I, at some point, with my ultimate wisdom, have made another version of it. But it's, isn't it an indicator list? Tools. Indicators, trend. Yeah, there it is. In oscillators in MT4, the demarker. So it's there. I think I've developed one over the years. I don't really use it anymore. My suite of iView MT4 indicators. There's a similar oscillator to demarker, but it's my kind of take on it. It's like a combination of different things, as most things are. There's nothing in iView charts that isn't known. The whole point of self-fulfilling nature of technical analysis is if I try and invent something that nobody else knows, it won't work. So I just take combinations of fibs, moving averages, Bollinger Bands, etc., and put them together in the right kind of way in the right time frames with some very clever algorithms in the back that make them adjust to the market conditions and filter in the fundamentals. So there's nothing there's nothing that I've invented that's new. It's just taking existing indicators and oscillators and packaging them together in the right way. But if you can be asked going out and spending 5 years to do that, knock yourself out.
So, Steve, let's talk about Intertrader for just a second, because
Sure.
you're chief market strategist for Intertrader. Your proposition is that you would like to mentor serious traders who want to put an amount of capital in the account, and you will, in return for that, you will manage them with a sort of a mentoring course, sort of keep in touch. What does that involve realistically? Is it contacting you on Skype, or how does it actually normally evolve, the mentoring?
Okay, well, I mean, the first thing about Intertrader is I've been the chief market strategist for 6 years now. It's like the Remington thing, if we're going back in history. I liked them so much that I joined them. Shai's a good mate of mine, the MD, and I've worked very close to these guys for a long time. Now, what I like about Intertrader is they're a market neutral broker. So you saw when the Swiss removed their peg from the euro that FXM needed a $300 million bailout. Why is that? Because they were trading a B-book, as it's called, against their own clients. So they got caught twice. Clients lost money, and they lost money trading. Now, your IG index, your Saxo Bank type things, they will trade against their traders. So it's one of the worst parts about trading that I really do despise. So they can see your positions, and they can take a position net above everyone's longs and shorts. Now, we don't do that at Intertrader. We're a neutral broker. So we invest in education. They pay me a lot of money to teach people like you. Because if you don't make money, they don't make money because they don't have a B-book. So I think ethically, as a standpoint, that's much better. So when IG Index lost half its share price in a couple of days after that FCA report, we didn't lose anything because we don't lose money in that situation because we have relatively good quality account traders that we don't trade against. So they will be classed as professional investors. So my point is, if you want to be part of me and my understanding of the markets, then you get the charts, you get the consistency, you get to understand fibs, you get to understand correlations, you look at things in the right way. Once you look at things in the right way, surprise, surprise, you make more money. Consistency, is all about looking at the same things time and time again, doing the same things over and over again and making money. Now, I give my support via Skype, which means we can chat on Skype till the cows come home, if you put enough money in. If you put £1,000 in, you don't get much time. Put £5,000 in, get a little bit more time. 25 grand, you get lots of time. 100 grand, you can come round to my house for dinner. Simple as that. Now, I'm saying this, the little kind of a jokey bit aside, because I do keep getting people asking me, will you take a punt on me? Or will you just let me have this? Anyone can have the charts for free. I don't care. But you can't have any of my time. Okay? I invest time in people who are realistic and have realistic goals. So I was speaking to a couple of my clients, at 5 in the morning over the Donald Trump, and Clinton elections. One of my top traders made 10 grand. Yeah, just on that at 5 o'clock in the morning. We were trading together, we were talking. I'll invest any amount of time in anybody who is going to be successful for themselves. Because if you're successful, InterTrader is successful. If InterTrader is successful, I'm successful. That's the way it works. You're not going to get anybody else like me, yeah, on all your presentations, Simon, that can give this kind of offering. Because I've worked with InterTrader for so long, I have a deal that nobody else could get near. And if I bring clients on who are serious traders, we all benefit. You benefit from my time and experience. I benefit from you making money. It's as simple as that. It's net win. It's ethical. It's good. And that's why I have millionaires, billionaires, contacting me, because that's it. I don't need any Razamadaz DVDs. I don't need anything. If you just want to come and talk to me, I'll help you. And if it doesn't help you, then go and slate me on the internet. I don't care. At the end of the day, I'm here to give an honest service based upon my time in the markets, my reputation as a trader, mentor, fund manager, etc., etc., etc. All the things you can just Google about me, and it's all free. Now, if it's free and didn't make me money, I wouldn't be here, would I? So you've got to really understand that this is, a once in a lifetime type thing, because come 6, 12 months, I might not want to do this anymore, and then that opportunity is gone. So at the end of the day, you've got 6 months really before the FCA changed the regulations on spread betting. So if you do want to benefit from the UK tax exemption from capital gains, etc., and you do have money to invest, and you are serious about making money, then I'll be your right-hand man. I will give you the charts, I'll give you my time to help you. So I don't know anybody else who's giving that kind of offering that, that's not going to cost you anything apart from moving to a broker that doesn't trade against you. I mean, it's a pretty sweet deal.
It's a very important part of it, and it's certainly one that more and more people are talking about, which is good news. So there's the link. If you want to go and head up and open an account up, and that'll get you straight through to Steve. Will be opened with his tags as you like, so you'll be able to open that account. This is sort of a mentorship package with Steve. Go ahead and use that link, London Investment Week /Ruffley. So, Steve, just one, maybe two more questions.
Of course, yeah.
Minute. Janet says, re-spread betting, what size of account will be required to be above these problems?
Okay, well, essentially, this will be an industry standard soon where they're going to put the cap at, you'll open a spread betting account with 5 grand. So 5 grand really is where I see the minimum that you should be really involved in if you're serious about trading for a living. This is, if you want to just punt, it doesn't really matter. And then the next serious bracket is probably 10 to 25, and that's when you can really buy yourself some time and buy some of my time, because you do have the ability to size up, scale up, and trade it in a way that will be beneficial to you. And then 25 grand above is it's healthy, it's big boy stuff. I have anyone between 100,000 and $250,000. And if you want to make serious money, and I'm talking about making yourself anywhere between 3 and 5, £10,000 a day. It can be done with a £100,000 account, and it becomes more difficult because your losses become big, and it's something we have to go through together. There is no format, unfortunately, for this kind of stuff. Trading with a £10,000 account is not the same mindset as a £100,000 account. I can guarantee that. But unless you're talking to somebody who's been there, done it, someone that's had £40,000, £50,000 winning and losing days, then how can you ever speak to, I don't know, name another person that just basically selling some book they've wrote. The whole point is, I'm telling you from experience, and it's difficult. It really is difficult to scale up, but that's where the money's to be made. And it's not holding trades for days, weeks, and months. It's trading large amounts of size in a relatively controlled way in volatile markets. And if you can average and scale into positions, then that's where you'll make your money, because you have the benefit of the average, where positions can lose, but other positions are winning, and net when you close out, you've made a profit. And that's generally what I teach people with generous size accounts to do, and that's how they make the money. There's no
Fantastic.
mystery to that.
Steve, thank you very much. Now you're going to come back next Thursday, give us a live update next Thursday lunchtime, 1 p.m. As well, which will be good.
Absolutely. We'll have Trump by then. We'll have the kind of UK Parliament decision, so there'll be lots to talk
Yeah,
about. And let's see. I mean, I'm expecting. Don't get me wrong. I'm expecting the pound to go up over time, but there still is a risk for it to go down to 115 against the dollar. But watch that correlation where the pound starts to outstrip the euro, and that will gain a lot more traction as I feel the European Union are losing their grip on their perceived idea that they're going to win the battle between the Brexit.
great stuff. Steve, good stuff as always. Thank you very much indeed for joining us. Okay, I think I'm going to take the presenter role back now, and we'll get ready for going on to our next speaker. So thanks very much.
Okay.
Thanks,
No problem. Cheers,
Bernard.
guys.
Brilliant.